$147 billion. That's approximately how much cash and Treasury securities Berkshire Hathaway held, according to their recent quarterly filings. The largest cash position in the company's history. More cash than most countries' entire annual budgets. And if you think Warren Buffett's investment decisions don't affect you personally, I need you to understand what this positioning might signal. Because Warren Buffett didn't become the most successful investor in history by accumulating cash during bull markets. He built his fortune by buying when others were fearful and selling when others were greedy. Right now, according to SEC filings, he's selling significantly, systematically, while markets hover near all-time highs. This isn't speculation. These are public filings, documented transactions, observable positioning by the man many consider the greatest investor alive. The question is, why? While you were watching markets climb and hearing reassurances about economic resilience, Warren Buffett was doing something different. According to Berkshire Hathaway's quarterly reports, the company has been reducing positions in major holdings. Apple, Bank of America, and other long-held positions have seen significant reductions. Simultaneously, Berkshire's cash pile has grown to levels that dwarf previous records. This isn't passive accumulation. This represents active choice to hold cash rather than deploy it into investments. Warren Buffett has said repeatedly throughout his career that he hates holding cash. He's called it a terrible investment that loses value to inflation over time. Yet he's choosing to hold more of it than ever before. When the Oracle of Omaha, a man who built his fortune by being invested in productive assets, chooses to sit on cash exceeding $147 billion, it warrants attention. Your 401k, your stock portfolio, your retirement timeline. These are all influenced by market conditions that Buffett appears to be positioning for. Understanding his reasoning, or at least his observable behavior, matters for anyone invested in markets. Now, let me be very clear about sources and limitations. I'm drawing from Berkshire Hathaway's quarterly 10Q filings with the SEC, 13F filings that disclose holdings, Warren Buffett's annual letters to shareholders, and his public statements at Berkshire's annual meetings. These are primary sources, official documents, public record. What I cannot tell you is what Warren Buffett is thinking. I cannot guarantee that his current positioning predicts any specific market outcome. I cannot claim to know the future. What I can do is present his observable behavior, compare it to historical patterns, and discuss what this positioning has historically preceded. The interpretation and any investment decisions remain entirely yours to make with appropriate professional guidance. This is education about one investor's documented behavior, not investment advice. By the end of this video, you'll understand exactly what Berkshire Hathaway's filings reveal about their current positioning, what historical precedent tells us about similar Buffett behavior, and what range of interpretations exist for his current strategy. Because here's what most people don't realize. This isn't the first time Buffett has accumulated massive cash positions. There's historical precedent we can examine. There's a documented pattern here, a pattern where Buffett builds cash when he believes valuations are stretched and deploys it when opportunities arise. The timing hasn't been perfect, but the general pattern has served him well across multiple market cycles. Same investor, same philosophy, different specific circumstances each time, but observable consistency in approach. The only question is whether you'll understand what his current positioning might signal while it's developing, or whether you'll only recognize its significance in retrospect. Stay with me. The next 15 minutes will examine what the filings actually show. To understand Buffett's current positioning, you need to understand his investment framework, not the simplified version, the actual philosophy he's articulated over decades. Warren Buffett operates according to several core principles. Principle 1, price matters. Buffett is fundamentally a value investor. He wants to buy excellent businesses at reasonable prices. When prices rise faster than underlying business value, he becomes reluctant to buy. He's said repeatedly, price is what you pay, value is what you get. When prices exceed value in his assessment, he stops buying. Principle 2, opportunity cost of cash. Buffett views cash as an option on future opportunities. Yes, cash loses value to inflation, but cash provides the ability to act when opportunities arise. He's compared it to insurance. You pay a cost, inflation, to have protection, purchasing power when assets decline. Principle 3, the fat pitch philosophy. Buffett uses a baseball analogy. Unlike baseball, investing has no called strikes. You don't have to swing at every pitch. You can wait indefinitely for the fat pitch, the opportunity you really want. When he doesn't see fat pitches, he waits, sometimes for years. Principle 4, margin of safety. Buffett insists on a significant gap between price and value, a margin of safety. When markets are elevated, margin of safety shrinks. When margin of safety shrinks, he reduces exposure. Principle 5, long-term thinking. Buffett doesn't try to predict short-term market movements. He positions for long-term outcomes. His current positioning likely reflects views on multi-year prospects, not predictions about next month. Understanding these principles provides context for interpreting his current behavior. Now, let me show you 3 historical examples of Buffett's cash accumulation and what followed. 1998 to 2000, the dot-com bubble. This example matters because it demonstrates Buffett's willingness to sit out market euphoria and the eventual vindication of his patience. By 1998, technology stocks were soaring. The Nasdaq was delivering extraordinary returns. Investors who avoided tech seemed foolish. Buffett was heavily criticized for missing the opportunity. What did Buffett do? He refused to participate. He said he didn't understand the business models. He couldn't value the companies. He sat on the sidelines while others celebrated. Berkshire's cash position grew. Buffett was called washed up. Major publications questioned whether his approach was obsolete in the new economy. Then came 2000, 2001, and 2002. The Nasdaq declined approximately 78% from peak to trough. Companies worth billions on paper became worthless. Investors who had mocked Buffett lost fortunes. And Buffett? He had cash. When others were forced to sell into the decline, he could buy. Berkshire's relative performance transformed from laggard to leader. The lesson isn't that Buffett timed the top perfectly. He didn't. He was early by years. The lesson is that his unwillingness to chase elevated valuations and his willingness to hold cash through criticism positioned him to benefit from the eventual correction. Pattern established. Buffett accumulates cash when he can't find value. Eventually, value returns. 2005 to 2008. The housing bubble. This example matters because it shows Buffett's ability to recognize systemic risk and position accordingly, even when the specific timing remained uncertain. By 2005, Berkshire's cash position was again growing substantially. Buffett was expressing concerns about credit markets, derivatives, and housing valuations. In his 2002 annual letter, he had famously called derivatives financial weapons of mass destruction. By 2006, he was increasingly vocal about excess in credit markets. Did he predict the exact timing of the crisis? No. He was concerned years before the collapse materialized. But he was positioned conservatively. When the 2008 crisis hit, Buffett had something almost nobody else had: massive liquidity. While others faced margin calls and forced selling, Buffett was a buyer. He invested $5 billion in Goldman Sachs at highly favorable terms. He invested $3 billion in General Electric. He made deals that others couldn't because they lacked the capital. These investments, made during maximum fear, generated extraordinary returns. Not because Buffett predicted the bottom, but because he had cash when cash was scarce. His 2008 New York Times op-ed, titled "Buy American I Am," became famous. He was buying because he could. Most investors couldn't. Pattern confirmed. Cash accumulation during good times enables opportunity capture during stress. The COVID crash. This example is recent and reveals both the benefits and limitations of Buffett's approach. Entering 2020, Berkshire held substantial cash, approximately $128 billion. Critics again complained that Buffett wasn't deploying capital effectively. Why hold so much cash during a bull market? Then March 2020 arrived. Markets crashed approximately 34% in 1 month. Panic was extreme. Opportunities appeared. But here's where the story becomes nuanced. Buffett didn't deploy massively during the March 2020 crash. He made some moves, but didn't unleash the cash pile as many expected. Markets recovered quickly, faster than almost anyone anticipated. The Fed's intervention was unprecedented. Some viewed this as a miss. Buffett had cash, but didn't deploy it at the bottom. The opportunity closed quickly. Others viewed it differently. Buffett's caution was appropriate given uncertainty about the pandemic's economic impact. The rapid recovery was driven by unprecedented monetary intervention that couldn't have been reliably predicted. This example demonstrates important nuance. Having cash provides opportunity, but opportunities must be recognized in real time. Judgment matters. Even Buffett doesn't capture every opportunity perfectly. The lesson isn't that cash guarantees perfect timing. It's that cash provides options that being fully invested doesn't. How those options are exercised involves judgment that even the best investors sometimes question in retrospect. 3 examples. Same philosophy, different specific outcomes. Consistent long-term success despite imperfect short-term timing. Now, let me show you what Berkshire's current filings actually reveal. The cash accumulation. According to Berkshire's quarterly filings, cash and Treasury securities have reached approximately $147 billion or higher in recent reports. The exact figure fluctuates with reporting periods, but the trend is clear, substantial, and growing. This exceeds the cash levels held before 2008. It exceeds levels held before 2020. It represents, by most measures, the largest cash position in Berkshire's history. The selling activity. SEC filings reveal significant selling of major positions. Apple, which became Berkshire's largest holding, has been reduced substantially according to 13F filings. The exact percentages vary by reporting period, but the direction is consistent: selling. Bank of America, another major holding, has also seen reductions according to SEC filings. These aren't small trims. These represent significant repositioning of the portfolio toward cash. The buyback slowdown. Berkshire had been aggressively repurchasing its own stock in previous periods. Recent filings show reduced buyback activity. This is significant because Buffett has said he only buys back stock when it trades below intrinsic value. Reduced buybacks might suggest he views even Berkshire's stock as less attractively valued. Possible interpretations. What might explain this positioning? Several possibilities exist. First, valuation concerns. Buffett may believe current market valuations exceed underlying business values. When he can't find opportunities meeting his criteria, he holds cash. Second, interest rates on cash. With treasury rates elevated, the cost of holding cash has decreased. Earning 4 to 5% on cash is very different from earning near zero. Third, preparation for specific opportunity. Buffett might be accumulating cash for a specific large acquisition he anticipates. He's made elephant-sized deals before when opportunities arose. Fourth, succession planning. At 93 years old, Buffett may be simplifying the portfolio for his successors. Cash is simpler than complex positions. Fifth, tax management. Some selling may relate to tax considerations, locking in gains at current rates or managing Berkshire's tax position. Sixth, he could simply be wrong. Even Warren Buffett isn't infallible. Markets could continue rising. His caution could prove premature or misguided. What we cannot know. I want to be very clear about what we don't know. We don't know Buffett's specific reasoning. He shares some thoughts publicly, but not complete analysis of every decision. We don't know if his positioning will prove correct. History shows he's been early before. He might be early again. Being early feels identical to being wrong until it doesn't. We don't know what he plans to do next. The cash could be deployed tomorrow into an acquisition we can't anticipate. We can observe what he's doing. We can compare to historical patterns. We can't know the future. Now, I know what some of you are thinking. Let me address different perspectives. But Buffett has been wrong before. He missed tech stocks for decades. True. Buffett avoided technology for years and missed enormous gains. He's admitted this himself. He's not infallible. But his overall track record remains extraordinary. Missing some opportunities while avoiding catastrophic losses has served his long-term returns well. His mistakes have generally been errors of omission, missing gains, rather than commission, suffering losses. But the market can stay irrational longer than you can stay solvent. This famous quote reflects a real risk. Markets can remain elevated for years beyond what fundamentals might suggest. Sitting in cash while markets rise is painful. Buffett has experienced this. He underperformed for years during the late 1990s while holding cash. He was right eventually, but being early was costly in relative terms. The question isn't whether patience is difficult. It's whether the alternative, chasing elevated valuations, historically leads to better outcomes. But this time is different. The economy is strong. Perhaps. Every market cycle has unique characteristics. The current environment has factors that didn't exist before. But this time is different are considered the 4 most dangerous words in investing. They've preceded virtually every major market decline in history. I'm not claiming this time isn't different. I'm noting that certainty about the future is usually misplaced. But following Buffett is just another form of market timing. Following any individual's moves without understanding their reasoning and applying your own judgment is problematic. The value isn't in mimicking Buffett's trades, it's in understanding his framework and applying relevant principles to your own situation with appropriate professional guidance. But I can't afford to sit in cash. I need returns. Your situation is different from Berkshire's. Buffett has a 70-year time horizon. Berkshire's perpetual existence. You have your specific timeline and circumstances. The framework matters. The specific application must fit your situation. That requires professional guidance, not YouTube videos. So what does this mean for you? Practically. Specifically, right now. I'm not a financial advisor. I'm not telling you to copy Buffett's positioning. I'm sharing observations about publicly documented behavior that you can incorporate into your own thinking with appropriate professional guidance. First, examine your own valuation framework. Do you have a method for evaluating whether your investments are reasonably priced? Buffett's framework emphasizes price relative to value. What's yours? If you don't have a framework, you're making decisions without criteria. Consider developing one, ideally with professional assistance. Second, understand your liquidity position. Buffett maintains liquidity to capitalize on opportunities. Now, what's your liquidity situation? This isn't a recommendation to hold specific cash levels. It's an invitation to consciously understand your positioning and whether it serves your goals. Third, consider your time horizon. Buffett can afford to be early. He has decades. His patience can outlast market irrationality. What's your time horizon? If you need funds within 5 years, your considerations differ from someone investing for 30 years. Fourth, distinguish observation from recommendation. Observing Buffett's behavior is not the same as recommending you copy it. His situation, tax considerations, opportunity set, and time horizon differ from yours. Use observations as input to your thinking, not as instructions for your actions. Fifth, acknowledge uncertainty. Buffett could be wrong. Markets could continue rising for years. His positioning could prove premature or simply incorrect. Anyone claiming certainty about market direction, including me, is overstating their knowledge. Maintain appropriate humility about the future. Sixth, consult appropriate professionals. Your financial situation requires individualized analysis. A YouTube video cannot account for your specific circumstances, goals, tax situation, or risk tolerance. Use this content as educational input, not as a substitute for professional guidance. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and upcoming videos will continue exploring investment philosophy and market dynamics. Drop a comment below. Tell me what you think about Buffett's positioning, whether you find his cash accumulation concerning or reasonable, what questions you have about value investing frameworks. I read every comment. This channel grows through engaged discussion with viewers seeking to understand markets more deeply. Here's what I want you to remember. Warren Buffett, through Berkshire Hathaway, has accumulated the largest cash position in his company's history. He's been selling major positions. He's slowing buybacks. These are documented facts from public filings. What this means is subject to interpretation. History shows he's accumulated cash before major market stress previously. It also shows he's been early and sometimes missed opportunities. The value isn't in predicting what happens next. It's in understanding how one of history's most successful investors approaches valuation, opportunity, and patience. His framework has served him across multiple market cycles. Whether it serves you depends on your application of relevant principles to your specific situation. The filings are public. The pattern is observable. The future remains uncertain. Thanks for watching The Silent Economy. And remember, the investors who build lasting wealth aren't always those who predict markets correctly. They're those who develop sound frameworks, maintain appropriate patience, and seek professional guidance for their specific circumstances. The data is available. The interpretation is yours. The decision-making requires appropriate professional support.